Wouldn't it be great to have a roadmap for successful investing? A step-by-step guide that empowers you to make well-informed choices and grow your wealth. Get ready to embark on this journey with us. This is Sundar and you are watching Mindful Finance. Recently, I got questions from my friends and colleagues asking that, okay, I got an idea that how to do based on Warren Buffett's tips. Now, I'm ready to invest, but how do I select my asset classes? Where do I invest? So this is the key question everybody asks. So this video is going to be a step-by-step guide. You will understand how to invest or where to invest or what kind of assets you have to invest based on your risk appetite. So let's get into that. The first step you have to understand is your horizon and your goal. Without your goal, you cannot do anything. In your life, even if I want to travel outside, if I want to travel to a place, if I need to just get out of my home, I need to have a goal that I need to buy some book. I want to watch a movie. Something or else you need to have, or I need to meet one of my friend. If you don't have the goal, you'll get bored. You'll come back to your home very fast and you won't feel something has done or achieved on that particular day. So leave your home with a proper goal. Similarly, the finance world also, you need to have a proper goal. It's like Abhimanyu. Some people know how to enter, but they lack how to come out of that, when to come out of that. Because they don't have a goal. They don't know why they started the investment first of all. So don't be in that mode. You understand your goal and make sure that whether your goal is a short-term goal or long-term goal. Like something like you want to go for a small trip, a vacation with your family, or you want to buy a home in another 5 or 10 years, or you want to save for your children's education in another 15, 16 years. So make sure your investment horizon is clearly defined, because in the investment, time is a very important parameter. Make sure that longer investment horizons often allow for a higher allocation to growth-oriented assets. You need to be prepared with the high risk and reward. I'll just share some example how to define this one. I have made a Excel sheet over here. I'll share to download. You can download and you can use it. This is something that an example for to define your goal. For example, Sam is a person. His age is 27 and he's having a kid of 2 years old, and his monthly salary is 50,000 and he want to retire by 55 years and when he is 55. Now his first goal is he want to have some surplus amount for his kids' educations. That would be around in 16 years. So when the kid is around 18 years old. What you have to do is currently as per the market, you have to find out what is the fee structure or how much you have to spend for your kids' education. So approximately you'd say it is a 10 lakhs. So including your inflation, assuming the inflation as a 5%, in the next 16 years, you would need 21 lakhs 82,874 rupees. You need to plan such a way that your investment has to cover this particular thing. And also assume that you have some kind of other goal, which is you want to retire. When you want to retire at the age of in another 28 years, which is when you are 55 years old. And currently, what is your monthly expense? It would be around, say, 37,500. Because your salary is 50,000. Assuming 25% is what your every month saving is going to be. So make sure at least minimum 25% of the salary has to go to your investments. So in that case, the remaining amount is your expense. It could be any kind of expense. I'm just in a rough estimate, I have added 37,500. It might be less. It should not be more. That is very important. In that case, every year you need to have 4,50,000. At the age of 55, with the inflation, every month Sam would need 1,47,004 rupees, and every year he needs 17,64,058 rupees. So this is what Sam needs, this much of amount. He has to be well aware of his investment goal and the duration. Let's see this example. I am assuming Sam is going to invest 25% of his salary, which is 12,500, and assuming a rate of interest as 12%, which is 12% rate of return. In 16 years, he will have 71,95,274 rupees. How much he need? He need 21,82,874. Peace. Right? Satisfied. My goal is achieved. From then, in another next 16 year, which is when the age is 55, Sam has to retire. So how much he will have? So we need to subtract this from this, so that remaining you have 50 lakh 12,400 at that point of time. And in another 12 years, Sam will be having how much? 2 crore 49 lakh 93,311 rupees. And if I keep on investing in the same way and assuming every year my return is 12%, I would be having 2,49,933 rupees per month. You can use this calculation to find out your own parameters. So in that case, your retirement goal is achieved. You need 1,47,000, but you are having 2,49,000, which is your goal of retirement also achieved. So this is a very straightforward assumptions I have made. But if you add every year 5% to your investment, this will be having a good amount of surplus. Plan your goals and the 10 years, the horizons properly, and plan your horizon and goals clearly so that you sleep peacefully. Now you understood your definition of financial goals and investment horizon. Now next, what is the next step? Understand different type of asset class. What is first of all asset class? Asset class is your investment, which is, it could be your real estate, it could be gold, it could be equity, it could be bond, anything, PF, BPF, lot of stuffs are there. So now you have to be very clear in understanding which asset class I supposed to invest. I'll give an example on this. You need to first understand the different types of asset class and definitions, basics at least. I'm not going to cover in detail, but you have to learn by yourself, or in my next videos, I'll try to cover the in-depth details of all this type of asset class. For now, just understand and take very simple asset classes, which are bonds, real estate, gold, and equity. You can have this as your simple asset classes. Based on your age, you need to understand how volatile these assets are and how risky these assets are. And based on that, your allocation has to be defined. The reason is every asset has its own cyclic parameter. Sometimes the rate of return may not grow in certain asset classes for a long term. In some of the asset classes, it may grow fast and same time it can go down also. So based on your age, when your horizon is long, 2 years, I need to plan for vacation. So you need money in 2 years. So you need a quick return and also risk-free return. But if a horizon is more, in another 15 years, I need to get my kid go to school. So your horizon is 15 years. So you can allocate more risky in asset classes like equity and less in your gold. So you can plan. The next one is determine your risk tolerance. You would have heard this thing multiple times if you are seeing this finance related things. Risk tolerance, or you can say risk appetite. So what it is about is when you go to sleep, you need to sleep peacefully. You should not have any kind of a tension about what happened in the market. Whether the market went down or it is shooting up, it doesn't matter. It should not disturb your it should not disturb your mental tolerance. It should not disturb you mentally. It should not affect your day-to-day life. So that is what this risk tolerance is all about. So understanding your risk profile and risk appetite is vital, especially from an Indian mindset. In India, we have diverse financial goals, cultural values, and risk perceptions. Some of us prioritize stability and some may want to preserve their capital, while others may seek growth and are willing to take more risk. It's important to recognize where we stand on the risk spectrum. Let's imagine two investors from different risk profiles. One is say Ravi and another person is Neha. Both eager to invest their hard-earned money. Ravi is a conservative investor. He values stability and prefers low-risk options. He's focused on protecting his capital and generating steady returns. Ravi might opt for fixed deposits or government bonds where the risk is relatively low, but the returns may be more. It's modest, more modest to say. It's not more, it's like modest. On the other hand, we have Neha, a more aggressive investor. She's willing to take calculated risk to achieve higher returns. Neha might explore equity investments or start her own business, accepting the potential for greater volatility. She's okay with whatever it is. So volatility is high, whatever it is. And she feels she wants a more substantial growth. Both Ravi and Neha are driven by their unique risk appetite and financial goals. It's crucial to understand our own risk profiles and ensure our investments align with our comfort levels. However, it's very important to note that even within these profiles, diversification plays a key role. We discussed about diversification earlier also. By spreading investments across various asset classes and sectors, we can manage risk effectively while seeking your growth opportunities. Ultimately, finding the right balance between risk and reward is a personal journey. For me, 1% risk with the 2% gain would be a better option. Or few might be thinking that my risk could be, say, for example, to do certain activities, I'm okay to take a risk of 100 rupees. With that 100 rupees, I'm going to gain 50 rupees. This is one scenario. The other person thinks, I'm okay to take 100 rupees risk, but I need to gain 200 rupees. There are different scenarios, right? So who is planning to take a risk is more, my reward is less. But other person seems that risk is low and the reward is more. So this kind of a mindset differs person to person. But the wise investors will always go with less risk, more rewards. That is a interesting part. So whether you lean towards a conservative approach like Ravi or embrace the more adventure path like Neha, understanding your risk profile is crucial. So whenever you are investing, understand which asset classes provide you conservative returns, which one has a more volatility but still gives more rewards for you. So understand those kind of things, and whether you are okay to handle those kind of a risk. Today, if you lose certain money, but in the long run, you may get more reward from that. You should be okay to handle those kind of moments. If you get scared and if you are not able to sleep properly, then you are not suitable for getting into a risk like equity kind of a mode. Better to go with a bond or fixed deposit. So that is what this risk tolerance is about. Next step is about establish an asset allocation strategy. We learned about diversifications. We learned about risk appetite. Now, okay, how do I strategize this one? So risk allocation strategies is a powerful approach, can help you optimize your investment portfolio and achieve your financial goals. When it comes to investing, one size doesn't fit all. Your risk tolerance, investment horizon, and financial objectives will play crucial roles here. That's where risk allocation comes in. In its essence, risk allocation involves distributing your investments across different asset classes such as stocks, bonds, and cash equivalents, even real estates. By strategically allocating your capital, you can potentially manage your risk and you can maximize your returns. The beauty of risk allocation lies in its ability to provide a balanced approach. It's like building a steady foundation for your investment journey, tailored to your specific needs. The next step, we'll explore a detailed risk allocation strategy based on age or considering your unique circumstances and everything. We can get into the detail of the strategy. So basically, how it done is it's a worldwide formula, which is like 100 minus formula or 100 minus your age formula. What is it about? For example, you are 20 years old. 100 minus 20. So based on that, the remaining 100 minus 20 is 80, right? So 80% of your investment has to go into stocks. The remaining 20% of investment will go to other categories. So now I'll show you in each age how can you strategically balance your portfolio. Let me show that one. When you are in age 20, 100 minus 20 is 80. So your 80% of your portfolio to stocks, which are like equities mainly, and 20% on bonds. When you are in 30s, that you are already married and you have a kid, now you have to plan for your kid's education and you need to settle down with your own home or something, right? So then you have to slowly start to focus on real estate. So when you are 30 years, 100 minus 30 is 70. So 70% of your allocation has to go to stocks and equities, 20% to the bonds, and 10% to real estate. So similarly, for when you are in 40 years, now slowly you have to reduce your stock portfolio because those are volatile instruments, and you have to work towards saving your capital. So 60% is your portfolio need to be in stocks, then 30% to the bonds, and 10% to real estate. And at the age of 50 now, you need to focus clearly on your retirement and reduce most of your stock portfolio and move it to bonds. So here is 50% is your portfolio stock and 40% towards bond and 10% to the real estate. So this is how you strategically allocate your assets based on your age. This may still vary based on your risk appetite That's what I'm saying. So our example, the previous example of Ravi and Neha, even at the age of 40 also people are okay to take risk, and they want to allocate their assets towards 80% toward stock and equities. That is also is possible. It's purely that how much loss you can bear. That is what the strategy is about. If you can, even at the age of 40, and your investment is 80% of your investment is in stocks, still if you are able to go to a bed in a peaceful way, that is 100% okay then. But make sure you don't have any debt, any kind of a commitment, any loans, no car loan, no home loan, nothing. Then it's okay to go with that kind of a risk appetite. Else, it's not an advisable one. So the reason behind asking to allocate your portfolio in a different asset classes are, if you see, this is the data which I have got from the past 20 years, from since 2000. If you see, these are the different types of assets: treasury bonds, Nifty, gold, and real estate. If you see, every year the rate of return provided by the asset classes, like bonds are in an average given 6%, Nifty has given 17.97%, gold has given 12.75%, and real estate has given 29%. But each year, if you see the volatility, Nifty has sometimes given a negative return of minus 11.9%, and here minus 28%, minus 13%. But if you see the bonds are always given you positive returns. It has never given you negative returns. That is why when your age grows, you have to make sure to move your stock portfolio, equity portfolio to bonds, so that you'll get a fixed returns or a proper positive returns. Even if you see golds are more, the commodities are normally called as volatile instruments. You can see how gold has been given a return, but at least most of the time it has given a positive return. In an average, it has given a 12.75%. Real estate, you can see it has given 29%. So you can partially look for real estate based investments also. It could be like REITs. Now the next step is select specific investments within each asset class. How do we do that? Once you have determined your asset allocation, choose investments within those asset classes. For stocks, you can select individual stocks. I have given a detailed video on Warren Buffett checklist on how to pick stocks. So you can check my video over here, and you can explore to how to select stocks in a Warren Buffett style of approach. So you can select stocks, individual stocks. You can pick individual stocks, and you can diversify your portfolio between index funds and specific stocks, or mid-cap stocks, or small-cap stocks. Right? You can plan your diversifications. Bond is something. So I keep on telling bond, and a couple of people even ask me what is this bond is about. Maybe I'll make another video to describe or explain in detail about what is this bond, and what is the benefit of bonds, and how this bond actually define our market trend. Those things I'll cover in other video. But you understand that bonds are something that it's a loan document, or it's a loan given to certain sectors. Like it could be for government, it could be for a corporate governance, or it could be for infra management, all those things. It's a loan given to certain organization, and the loan is repaid by those organizations. You are being part of that. You will be part of the loan lenders, and your money has been given for a loan, used for a loan. So that way, whatever the interest they are getting, that will be shared across. The rate of interest or return may be less in a shorter time, but it will be a steady income, and you won't lose your investment. So that is a key point in bonds. The next point is consider diversifying your assets, not just within our India. You can plan to invest in different countries. Like you can invest in stocks in US, you can invest in stocks in UK. US has option to invest in stocks, but there are mutual funds. They does help you to invest in other countries. Now you have created your portfolio, you have created asset allocations, you are able to understand your goals and your horizon. The next thing is there is more to a journey. The importance of monitoring and rebalancing your portfolio, which is a very important thing, and it helps to have a continuous growth in your portfolio. Your investment journey is like navigating a ship in a constantly changing waters. Market conditions, economic shifts, and individual investment performance all influence your portfolio. That's why regular monitoring is crucial. It allows you to stay informed about how your investments are performing, and more importantly, whether they align with your financial goals. Imagine you are started with a well-balanced portfolio with a mix of stocks, bonds, and other assets. Over the time, some investments may outperform others, causing your portfolio to deviate from its original allocation. This is where rebalancing comes into the picture. By periodically reassessing your portfolio and realigning it back to your initial targets, you maintain a desired risk level and potential for growth. For instance, if your original plan was to have 60% stocks and 40% bonds, but due to stock market gains, stocks now make up 70% of your portfolio because of the bull run. You might consider selling some stocks and booking a profit and trying to reinvesting in the bonds to get back to the original allocations. So that is the key thing. So rebalancing not only helps manage risk but also forces you to buy low and sell high. It's a key principle of successful investing. Some people may differ on this argument. Some people are there that they just want to stay invested and they don't try to sell or try to book profit. They only buy at the low. They won't try to sell. There are multiple reasons behind that, and also psychologically sometimes if you are not well versed of finding the lows, problem is after selling at high, you may not be able to re-enter. You won't have that guts to re-enter again. You will find confused to when to re-enter. You might be waiting for the stock to go low, but it may not go low. It's still continuously going on high and you won't get an opportunity to re-enter again. So that way you lose the good stocks for a long time period. So remember, monitoring and rebalancing are not about chasing quick gains or timing the market. It's about maintaining discipline and staying true to your investment plan. As you continue on your investment journey, don't forget the power of monitoring and rebalancing. These simple yet powerful steps can keep your portfolio on course, helping you navigate the seas of financial success. If you are able to do these kind of things by yourself, it's well and better. That's why I'm making all this video. And if you are liking this video, please subscribe and comment whatever you feel about this one. If you want to have more or if you want any specific details, do let me know. I'll post on it. Make sure to manage your portfolio by yourself. The reason is it's your money. It's your hard-earned money. You are the person who will know about how to handle your money. You are supposed to know about how to handle your money. Somebody will try to help you out how to handle the money. You cannot trust someone just blindly that they will help you in every situations. So be mindful, understand the finance, understand the basics of this one. Don't complicate the things. The videos which I am making it are mainly for you guys to learn it in a simple way rather than complicating your life. It may take 1 or 2 years to learn. Start with the small money. Start picking stocks by yourself and start the investment. Don't have FOMO. Don't have fear of missing out. Market is something like, it's like a goddess. It gives opportunity to everyone. But you should not be a greedy person. You should thank God, thank the market, and mindfully start your investment journey by picking the stocks by yourself, analyzing the stocks by yourself. If you are not able to do that, better find a SEBI registered advisor and let them handle it. Don't go with your friends or colleagues or any kind of influencers. Do your investments mindfully. Thank you.